Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. In today's presentation, we are going to discuss key aspects of budget, which is going to impact dollar rupee pair, outlook on dollar rupee pair, and then ideal strategy for exporters and importers. Important aspects which we look in order to understand what is the impact of budget on rupee. There are three parameters. One is fiscal deficit, second growth aspect, and third FII, FDI, or any boost in exports. So the first important aspect is fiscal consolidation. I think from FY21, when the fiscal deficit was close to 9%, this government the focus has been very clear. They want to reduce the fiscal deficit. Between FY25 and FY26, they have further reduced their fiscal deficit estimate by 40 basis point. Now the fiscal deficit number what they are targeting is 4.4%. Apart from that, the aim of the government is to reduce the debt to GDP ratio close to 50%, which is currently uh, trading near 57.1%. This fiscal consolidation part will start from FY27 and they will reach to this number by FY31. This also gives an indication that government is very determined to reduce the fiscal deficit. Now, how they are able to reduce the deficit? Either they can do it by spending money on non-populist aspects, or they can increase the tax revenue. If you see the chart, it is very clear from the chart that they are not increasing the subsidies on fertilizer, food, petroleum. They're keeping it at a very minimal level, not going by the populist budget, instead spending money on capex and growth. Now, second aspect, we have to understand how they're going to boost growth. Now, if you see the percentage of expenditure has been reducing, but what important aspect is that they are increasing expenditure on the capex. Once you increase expenditure on capex, it is going to act as a multiplier effect on the economy. Apart from increasing capital expenditure, they also want to boost consumption. For that, they have reduced the tax slab. Till 12 lakhs, there is no tax. And they had given higher allocation to agricultural and rural development. The third aspect what we need to understand is about FII, FDI, and government strategy to boost exports. In the FDI segment, government is allowing 100% FDI in insurance sector, which is currently 74%. As far as exports is concerned, they have launched a body called Mission Export with a total allocation of 2,250 crores. The body is going to help exporters in three aspects. First aspect is to export to increase export credit. Second, cross-border factoring. Third is to support MSME related to all areas of export except tariff wala part. So basically, we can say that budget is technically speaking neutral to positive for rupee. Now let us understand what is the outlook for rupee for coming days. For making the view of rupee, let us understand few key factors. First factor is dollar index and 10-year yield. Technically speaking, dollar index chart and 10-year yield charts are suggesting that they are going to face tough resistance. Dollar index is going to face tough resistance near 109 to 109.50 kind of level, and probably it is going to move towards 106 to 107 kind of levels in coming days, which is positive for rupee. Second factor to consider is crude oil prices. In last 15 days, crude oil has corrected by almost 8 to 9%, and basis of de-escalation of war, it is expected to remain in a range-bound manner, which is also positive for rupee. And the third aspect is few of the corporates are going to raise funds in dollar. For example, Union Bank is going to raise $3 billion. Adani Power and Bank of India are going to raise 500 million, because of which there will be support in the rupee. On the negative side, we have seen that FII have been selling in the Indian equity market from last couple of months, but we are expecting that things might change because of good budget and 10-year yield coming down. But saying that, till the time FII are selling in the Indian equity market, pressure on rupee might continue for some more time. Third negative aspect for rupee is in Indian banking system, rupee liquidity deficit is there. Probably we are currently having 1 trillion ka liquidity deficit. If the deficit continues for a longer period of time and the flows come in, then RBI might buy dollars to infuse rupee liquidity in the system. Based on plus and minuses, we can conclude that rupee can continue to trade in a narrow range between 86.20 to 86.80 kind of level. If the pair is breaking either side, then we will see a fast and furious momentum of 50 to 75 paisa in the direction the pair gives a breakout or breakdown. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of them are taking costing between 86.25 to 86.50 kind of levels. For them, we are suggesting that any level above 86.50, they should go and cover 80 to 100% of their exposures. If anyone wants to wait, they should keep a strict stop loss of 86.20 or costing, whichever is higher. Thick margin exporters like textile exporter or engineering exporter, for them we will suggest that they should hedge at least 55 to 60% of their confirmed order. In order to participate or maintain the hedge ratio, they can participate between 86.40 to 86.60 kind of levels. For remaining exposure, we will suggest them they can keep a strict stop loss of 86.20. Now let us discuss strategy for importers. For importers, the strategy is very simple. Keep a strict stop loss of 86.70 and wait for lower levels of 86.20 to 86.30 for covering near-term imports. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.